Good morning, everybody, and welcome to our April 2024 IFRS and corporate reporting webinar. Now, in this month's webinar, we're looking at the continuing challenges in lease accounting. It's hard to believe that IFRS 16 has been in play and implemented since the 1st of January 2019. So 5 years later, we still talk about lease accounting and the continuing challenges. Over recent months, we've seen a few new themes pop up, a few new types of questions being asked. And we'll try and look at some of the oldies that are still really good, but we'll also talk about a few new challenges around lease accounting. Now, as always, I'm joined by my partner in Sydney, Kevin Frohbus. So good morning, Kevin.
Good morning, Aletta, and good morning to everybody. It's good to be back on this April morning. And yes, Aletta, when we started to brainstorm this topic, it turns out that it was an oldie but a goodie again. And there's a lot of new topics that came out of our preparation for this webinar. So hopefully we can bring that to your attention today.
Yes, that's true. So we thought it will be a short webinar with a few highlights because this is an old standard. It turns out there's quite a few things to talk about. I would like to begin, or we would like to begin, by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past and present. In Melbourne, I'm meeting on the land of the Wurundjeri people of the Kulin Nation. And we extend that respect to Aboriginal and Torres Strait Islander peoples here today. If we look at our monthly IFRS and corporate reporting webinars, we're already in the April one. And I want to do a little bit of an advertisement for the May webinar. The update on financial and sustainability reporting and preparing for 30 June year ends, or 30 June 2024 reporting. Looking at the statistics, this particular webinar, the May webinar, is the one that's the most watched, most attended, recordings most viewed each and every year. Because we know that finance teams, board members, audit and risk committees want to make sure they're across all the latest information when they prepare for 30 June financial reporting. So please mark that in your calendar. If you can't attend the live one, please watch the recording. We try and share all the latest and greatest. And another reminder, it's the one webinar a year that's actually 90 minutes and not 60 minutes, because we know there's so many things to talk about every year. So a few years ago, we decided to set realistic expectations of 90 minutes. So please join us for that particular webinar next month. We also do monthly sustainability webinars, and if you attend these, you would have known that it is, already the third year we're doing it. You would know that in January, February, and March, I've been doing them all on my own. So I'm really, really excited to announce that Kevin has agreed to present these webinars with me. I need my partner. And from April, when we look at understanding carbon accounting and why it's important, Kevin will be joining me every month. So Kevin, thank you very much for to be willing to agree and to participate. I'm looking forward to it. It's really lonely to present a webinar on your own. You can't see anybody. You're looking at a laptop. I really need a partner. So thank you very much. Then Kevin and I are also running some carbon accounting masterclasses. We're running these masterclasses in Adelaide, Brisbane, Melbourne, Perth, Sydney, and then a virtual one in June. Kevin will be joining me in Perth and Sydney. In Melbourne, I'll be joined by Dylan Byrne. And in Brisbane, one of our local managers will be joining me. And in Adelaide, again, there are two sustainability assurance partners that will be popping in. So very excited to look at carbon accounting. Carbon accounting particularly important at the moment because a lot of customers are starting to demand that that information be provided to them, not climate risk assessment and all the other things, but at least tell us whether you've got a carbon footprint, what your carbon footprint is, whether you've got targets, and how you're tracking against those. So it's a journey. I think really important that we understand carbon accounting from a compliance but also strategic perspective. So today's agenda. We've come up with a long shopping list of items that we see in practice around leases and continuing challenges around lease accounting. So we would like to work through these in an orderly fashion. So some of them I'll be addressing, some Kevin will be addressing, but you can see quite a number of things to talk about. So off we go, Kevin. Maybe before we look at that, I've included a slide that includes a link to a BDO Global publication on IFRS 16 leases. It's been updated at the end of last year, I think released the beginning of this year. It includes all the latest and greatest IFRIC agenda decisions. Still an amazing publication, right from 2018, 2017, when it was first published, till today, continuing to improve it. Beautiful publication with amazing examples, and we referred to it a lot today during the presentation. Highly recommend that you look at this particular publication. So the first issue we thought we'll talk about is service concessions versus leases. Now, it's important to understand, where do I get that from in the middle of thin air? I thought we're talking about leases, Aletta, IFRS 16. If you look at the scope of IFRS 16, and by the way, Kevin and I have often talked about scoping of accounting standards and how difficult it is, and that the real wisdom, judgment, experience is identifying which accounting standard is appropriate for a particular situation and transaction. So am I within the scope of IFRS 16, or am I maybe within the scope of something else? We've often talked about the interplay between IFRS 9, IFRS 15, IFRS 16, which in essence is a scoping issue. Now, this is one that maybe we haven't explored extensively, and it's also a scoping issue. In paragraph 3 of IFRS 16, it says an entity shall apply the standard to all leases, including leases of a right of use assets in a sublease, except for, right? There's always this, all leases, all revenue, all financial instruments, and then they have this except for. And here they say all leases except for, and they listed a number of items. And I want to point you to number C, service concession arrangements within the scope of IFRIC 12, service concession arrangements, or in Australia, it's called AASB Interpretation 12. So basically what they're saying is, if it is a service concession arrangement within the scope of IFRIC 12 or AASB Interpretation 12, it's scoped out of IFRS 16. So you first have to assess, is it maybe within the scope of IFRIC 12, right? That's where you start. If it's not a service concession arrangement, then you'll go and look at IFRS 16. So that's just a little bit of context. It's around scoping. Now, this is a decision tree that we've put together a number of years ago, and I know we presented a webinar on this, Kevin. This was a project we've done for community housing providers in Australia. In 2018, 2019, we worked on together around whether a number of these arrangements that community housing providers have, whether they are actually leases or not, and if they're leases, how do we account for it? And what we've uncovered at the time, which was a bit of a revelation, is that many of those agreements, which were thought to be leases, were actually service concession arrangements. And this is the decision tree that we step through. You start by saying, we want to know, is it a service concession arrangement, or is it potentially something else, which often is a lease? And you would say it's a service concession arrangement if you say yes to the following. Does the grantor control what services the entity In our case, my example, the community housing provider, the CHP, should provide with the property. So it looks as if the CHP is leasing a property from the grantor, but actually that lessor/grantor is dictating and controls what services we have to provide with the property. It's not you lease the property and do what you want. No, no, no. You can use this property, but this is what you use it for. And these are the services you have to provide. That's one thing. The second thing, the grantor also controls to whom the services should be provided. So it's not you have to provide services to anybody. There's a certain selection criteria, and you can only provide the services to them. And then the third thing, the grantor controls the price at which the services are charged. So you have to provide these services to these people, and you can only charge a certain price, or there's a maximum price that you can charge, or there's a formula on how you work out the price that you charge. So that's critical. Now, if you say yes to all of those, then we get to another aspect, and that is the property used in this arrangement for its entire useful life? If that is the case, again, is the property constructed or acquired by this provider from a third party for the purposes of this arrangement? Yes, then you would get to service concession arrangement. But even if you're not acquiring it, even if you're not constructing it, if that infrastructure or the existing property of the grantor, is it infrastructure or existing property of the grantor to which this community housing provider is given access for the purpose of the service arrangement? So you have to provide these services to these people at this price. You're going to use it for its whole useful life. You don't have to construct it, you don't have to buy it, but we give you access to it. All of that ticked. This is a service concession arrangement. You apply AASB interpretation 12, and you do not apply IFRS 16 around leases. And the outcome drastically different. So I just want to say again, often to our public sector attendees of the webinar, a lot of not-for-profit attendees of the webinar, but we also see it in the private sector, for-profit world. Are you sure your leases are not service concession arrangements? And the kind of things that will start to flag it is if you have to provide certain services at a certain price, you are dictated around that. Then I think we should investigate a bit further. Now, Kevin and I both have a number of clients that come to us and say, please help us with your fancy technology tool, BDO Lead, do these calculations. Here are all our leases, or here are all the agreements. And then when we look at it and when we analyze it, we realize, hang on, these are not leases, these are service concession arrangements. Please feel free to reach out to both Kevin or I if you want us to assess some of your agreements on whether it's actually a lease or a service concession arrangement, and on advice, what does this mean if it's a service concession arrangement within a AASB interpretation 12. It's amazing, Kevin, this is an oldie, but a goodie, and I think a number of people were caught unawares by this particular interplay between service concession arrangements and leases. So we'll put that on the table. The other thing, or the second thing we thought we'll talk about, is the identification of leases. Now, interesting here, you know, if the agreement says I'm a lease agreement, you know, people get excited. Yes, we do the right thing. It's a lease. Sometimes, you know, it looks like a lease, but it's a service concession arrangement. Yes, that happens. Other times, it's a contract, a normal contract for services. And when we look at it and scratch beneath the surface, it's actually a lease, or maybe part of it is a lease. Embedded in the contract, there is a lease. So the identification of leases is actually really important. I'm concerned that often we look at service arrangements and we don't identify it's not a service arrangement, it's a lease, or we miss the fact that a big part of that service arrangement includes an embedded lease, and we're not separating the two. So this is a recap. It's a graph from our BDO Global publication asking the question, is there an identified asset? If we say yes, does the lessee obtain substantially all the economic benefits from the use of that identified asset throughout the period of use? So not throughout the expected useful life, throughout the period of use, the term of the agreement. And lastly, does the lessee have the right to direct use of the asset throughout that period of use? So not the useful life, but just the period of use. So those are the high-level criteria we have to consider and document. And, you know, if these are present, you can see right at the end, you will say the contract contains a lease. It doesn't say the whole contract is a lease, but somewhere in the contract, there is a lease component potentially. So I think we have to look at that very carefully. Just to illustrate to you that this BDO publication really includes all the latest and greatest, they've put in an IFRS Interpretations Committee agenda decision, a fairly recent decision around economic benefits from the use of a wind farm. Now, I've picked this one in particular, and I'm sure, you know, Kevin's going to laugh, because the questions we're currently getting around this are around renewables. So, you know, whether it's a wind farm, whether it's a battery, and you have an agreement to take energy out of the battery from the wind farm, from some kind of renewable energy provider, the question is always that arrangement. What's the scope? Where does it fit? Is it IFRS 9 a derivative? Is it IFRS 16 a lease? Is it a combination? And there's, you know, there's hot debates at the moment around these. A lot of discussions around virtual power purchase arrangements, not just the normal traditional power purchase arrangements, but virtual power purchase arrangements. So I just wanted to put it on the table that this is an incredibly complex area. It's very common within latest developments, batteries and wind farms and everything. And with our sustainability hats on, Kevin, we know this is going to happen more and more and more. So this is just an example already raised with the IFRS in 2021, and they said, you know, if an electricity retailer and a supplier purchase and sell electricity via the market's electricity grid, the spot price of which is set by the market operator, the retailers enters into agreement with the supplier for a period of 20 years to swap the spot price of the electricity supplied to the grid for a fixed price to be settled net in cash. And the agreement also transfers to the retailer all renewable energy credits, carbon credits, all renewable energy credits that accrue from the use of the wind farm. So the question was asked, you know, what do we do with this? So the committee observed that in the fact pattern described in this request, the economic benefits from the use of the wind farm include the electricity that it produces, so that's the primary output, and the renewable energy credits, which is a byproduct or another economic benefit from the use of this wind farm. So there's two things here. And the committee further observed that the agreement conveys neither the right nor the obligation for the retailer to obtain any of the electricity the wind farm produces and supplies to the grid. Therefore, they've said the retailer does not have the right to obtain substantially all the economic benefits from the use of the wind farm, and this particular agreement does not contain a lease. Right, so you can see how tricky this gets within the renewable energy space. So I would like to say, if you are involved in use of batteries, wind farms, renewable energy, please speak to us. This is the future, and we'll see a lot of this, and would love to work with you on that. And the third thing looking at is just a bit of a recap. If we look at lease accounting, initial recognition and measurement, we know that you work out your lease liability, and then the lease liability is the starting point to what we have for the calculation of the right of use asset. So you add all these payments in, you get your lease liability. That is the starting point of the right of use asset, and then you add these other additional costs. Now, later on, Kevin will talk about make good provisions and how that links with this, but this is just a little bit of a recap of the mechanics of how it works together. We also know, as part of that initial recognition and measurement, I often get asked, why don't we put CPI payments in? I know CPI is at least a certain percentage every year, or there's an expectation. Why is it not in? It's because within the basic rules, fixed lease payments are included. Variable lease payments, we put in the payment we make at commencement date, and then when it changes sometime in the future, when it's not uncertain anymore, we know what the new payment is, then we update all the future payments. So it's important that fixed payments get treated one way and variable payments a different way. We don't exclude variable payments, we just include it at the payment at the date. Something interesting here, it sits within the category of fixed payments, and that is in substance fixed payments. I've had some questions around this one recently and provided some advice. And really interesting, the conversation we've had. In substance fixed payments, if you look at the legal form of those payments, they are variable lease payments. The issue is when we analyze these variable lease payments, we understand that although legally in the contract they look variable, in substance, they're actually fixed. So applying your judgment on in which situations would a variable lease payment become in substance fixed is actually difficult, a lot of judgment required. And there's a lot of guidance throughout the standard on these are definitely variable, cannot be in substance fixed. These are situations that could potentially be in substance fixed. So I just want to flag in substance fixed payments. I'm thinking that a lot of people just see a variable lease payment and decide it's variable on they go, and don't maybe give enough consideration on whether that variable lease payment is actually in substance a fixed lease payment. So that's just another thing to just flag. Determining lease term. Now this one we've talked about a lot. There was an IFRS agenda decision about this one. We know this is incredibly important. I'm not going to step through all the thinking. We've done it so many times, but I think the key thing here is plain and simple. Lease term is not just the legal lease term, right? We have to look further than that. We have to have an economic overlay, dare I say, an in-substance overlay. It does bring me a little back to the previous slide where we've got variable payments, legally variable payments, in substance fixed payments. Here we can have a legal lease term, but when we look at the substance in the economic reality, the lease term is something very different. So it's a reminder of that. You would have seen we've previously flagged this decision tree, which is incredibly important, where you've got your first part is your a period when no party can actually cancel the lease. That's the minimum. Then you have to consider whether there are termination options, and not just whether there are termination options, which parties have the option to terminate. It could be both lessor or lessee, just the lessee or just the lessor, and that has different consequences. And then we also look at extension options and termination options and consider the guidance around how do we assess a lease term. Critically important, and while we talk about lease term, critically important that we think further just than legally what's written in the agreement. And the way we see this in practice, a lot of people want to look at the legal lease term because the legal lease term is quite short, or maybe the legal lease term is just 30 days or just 6 months. They want to use that argument to say that this lease is a short-term lease and not subject to IFRS 16. And clearly that's not the case. We don't just look at the legal lease term, we take all these considerations into account. The best example of lease term is actually a holdover lease. So if you've got a lease for legally 5 years, and then after the 5 years, that lease goes into holdover, so it becomes a month-to-month lease. Economically, you might be compelled to stay in that property for various reasons, even though it's now in holdover. Actually, even from day one, there was a lease period of 5 years, and then it goes on to holdover. Already on day one, we could assess realistically, economic reasons, substance, we're going to stay here for 20 years. And then the lease term is then 20 years. So, just a reminder to be careful on those, assessment of lease term. So you have to holistically, economically, in substance, look at this. Legal lease term, options to extend, option to terminate, holdover periods, etc. Renegotiation of these holdover leases have been quite problematic in practice, and we've seen it at various clients. So that the example is, what if I have a 10-year lease of a building that expires in May 2023? And then from the 1st of June 2023, the lease is in holdover, so it's just on a month-to-month basis. And the entity is busy negotiating a new lease. So we're trying to get to an arrangement or a deal with the landlord. We're trying to get to a new lease term of another 3 years. We're trying to negotiate that we'll pay $8,000 per month. That's what we're trying to put in place. And then finally on August, the entity enters into the new lease agreement. It ended up being a 5-year lease, and it ended up being $10,000 a month, so slightly different to what we've expected in June. And what is critical here is we had a year end at 30 June 2023. So there's a few angles here that I want to point out that people get wrong. Number one, if you lease a building until May 2023 and you get to the end of the lease of May 2023 and now you continue to use it, it's important to understand that when you finally enter into a new agreement in August, it's not a new lease at all. You are continuing to use the same property. So legally, separate piece of paper, it might look like a new legal agreement, but in substance, you've just modified your initial lease arrangement. So again, we're coming back to new legal agreement versus in substance, I'm just continuing to use the same building, the same property. So it's a modification under IFRS 16, not a new lease. That's one thing. Second thing, when we get to the end of May, we don't treat this lease as an expired lease and remove the cost and remove accumulated depreciation and now just expense it every month. No. We say, hang on, we've got an expectation to stay here for another 3 years at a certain value. We modify our existing arrangement, and we modify it on the 1st of June. So we consider, and Kevin will talk about it, on the 1st of June, what is the IBR on the 1st of June? When we modify, we estimate will be here 3 years at $8,000 per month. So already at 30 June 2023, you have this new lease liability or increased lease liability, increased right of use asset, critical, right? And then on the 1st of August after year end, you sign the agreement. And again, now we've locked it in, update the lease liability. It's now 5 years at 10,000. It's a modification again. IBR on the 1st of August again. So you can see this is the answer under IFRS 16 of a modification on 1 June, a modification on 1 August, gives us a very different answer to treating this as an expiry of a lease and now just month-to-month expensing. So please be aware, this is, I dare to say, the most common issue I see in practice. Then the other thing, the ongoing changes to lease portfolios. This is an old diagram. still one of the decisions trees that we've developed that we are most proud of. On an ongoing basis, if you get your leasing numbers correct on day one, when you first adopt IFRS 16, a lot of people thought, okay, then it's over. No, no, no. Now you deal with these ongoing changes. There will always be new leases. There will be remeasurements. There will be modifications. There will be terminations. The rules on how you deal with all of these, when you update discount rates, when not, when we expect a profit and loss impact, when not. It is very complex. This decision tree is still the one that we use daily when we provide outsourced lease accounting services to our clients. So it gives you a bit of an overview. What are the types of reassessments? How do we deal with it? What are the types of modifications? How do we deal with it? And how do we deal with terminations? And all of this captured seamlessly in our lease accounting tool, BDO Lead. CPI adjustments very quickly. Remember, a CPI adjustment, the initial measurement, we include the amount that we're currently paying. The fact that there's a CPI adjustment in 12 months' time and then another 12 months and another 12 months, we ignore all of that. We don't know what it's going to be. We take in the payment today and we assume we're going to pay that for the rest of the lease. A year later, when that payment increases as a result of CPI, we then say, okay, now we assume for the rest of the lease term, we're going to make that payment. So it is not something we do on day one. It's a continuous thing, very different to a fixed increase. We know it's fixed. We already bring it in on day one. So this one, new leases, which are actually modifications. It's a little bit similar to a previous example. If you've got a new legal lease agreement, but you're continuing to use the same asset, same vehicle, same property, it's a lease modification under IFRS 16. It's not a new lease for lease accounting purposes because in substance, it's still the same asset. So just a reminder. Expired leases, remember at the end of the lease term, when a lease expires and you're genuinely no longer using the asset, you're giving it back to the lessor, you should have no right of use asset and no lease liability in your balance sheet. That's true. Because your cost of your right of use asset will be fully depreciated and there won't be a liability left. However, we don't want to sit with that original cost and that accumulated depreciation, same amount. We don't want to sit with that in the balance sheet forever and a day. We no longer have them. So we have to remove that original cost and we have to remove that accumulated depreciation. Different to an expiry is an early terminated lease. So before we get to the expiry date, we decide to no longer continue using the lease. We terminate it. For clarity, I've said early termination. All terminations are always early. But, you know, we would expect a profit and loss impact. There will be something sitting in the right of use asset. There will be a cost. There will be accumulated depreciation. It wouldn't be fully depreciated when we terminate. There will still be a liability sitting there usually. So you have to remove all of those and then the net effect will have an impact on P&L. Kevin, at this stage, happy to hand over to you so I can catch my breath and you talk about incremental borrowing rate.
Thank you, Aletta. And while you were talking, I realized there's a lot of content there to take in. And I think the message that we've been talking about for 5 years is that lease accounting is really a bringing together of certain processes and controls in data and information management. It's not a one-off exercise, it's a continuation. And more I'm finding in practice, the key to lease accounting is essentially organizing your resources and in such a way that data can be managed and the flow of data can be managed to bring this all together. While Aletta was talking, I was like, you first need to bring together the skills in IFRS to make an assessment of whether you actually have a lease, is the first question. And that has to happen every time a new contract is signed or a new arrangement is entered into. So do you have a service concession and do you have an embedded lease? So there's some sort of contract management process going on there. And you often need to get your property management team to kind of discuss and be involved in that. And then, of course, there's the ongoing data, CPI changes and increases in fixed rate and market rent reviews and early terminations. Those are all points of data that essentially need to be brought together from various teams. Incremental borrowing rate, which is the topic that I'm going to talk about, is one of those data inputs. And often it comes from the treasury function in your organization. Now, not every organization has a formal treasury function on the side, but it is a finance decision. So it's not coming from the portfolio management team, and it's not necessarily coming from the operations or even the finance team. It sometimes comes from, a treasury function or the person who is able to access things like what is our borrowing rate in terms of borrowing. So getting into borrowing rate, this particular section I'm going to deal with actually talks very specifically about that particular data input, incremental borrowing rate, because as you know, in lease accounting, lease liability is the future fixed interest rates plus sometimes CPI and other variables in terms of your future lease payments, discounted back to a present value. So I'm talking about the discount rate used to discount it back to the present value. Now, I'm going to go through some basic topics here, and the reason why I'm going to spend a bit of time on this is because the incremental borrowing rate has become really material and significant in the last 12 to 18 months. Why? Because we've entered a high inflation economy. Interest rates have been driving up. They seem to have sort of stabilized a bit, but globally we're into a high interest rate environment, and the appropriate discount rate isn't a thumbsuck anymore. Not that it ever was, but Aletta will tell you that back when the standard was implemented, we were dealing with some very low interest rates, like maybe 1.5% in some cases, and it didn't really have much of an impact on the lease liability measurement. Well, that is not the case anymore. So going back to the original theory on this, can the interest rate implicit in a lease be readily determined? In determining the appropriate discount rate, there's really two ways to work out your discount rate. Do you know what the rate is implicit in the agreement, or do you have to work it out through some sort of implied calculation, which is what we call incremental borrowing rate? Now, the best example of this is if you sign an agreement normally for vehicle fleet finance or a motor vehicle fleet finance. Sorry, Aletta, I'm just getting a very bad echo. I don't know if that's you, but I'll keep going. If you get if you sign a fleet finance, your incremental borrowing rate is obviously implicit in the agreement. They'll say to you, we're financing the vehicle at 4%. Then you'll know what your discount rate is. But with property in particular and other sorts of arrangements, that's not readily apparent. And so then you have to use an incremental borrowing rate. And it's that incremental borrowing rate that is the subject of today's session, because it's not that easy to determine an incremental borrowing rate. In fact, back in the day when we started implementing this, entities were using things like their revolving credit rate with the bank. And in some cases, they were just saying it's 1 or 2% because it seemed like a good starting point. But that era is now over. And the reason why we know that is over is because in our audit practice and in our advisory clients where we have auditors who are other firms, we are getting a pushback from those auditors who are saying, stop. You need to go and actually get a proper valuation of your incremental borrowing rate because the number you're using isn't appropriate, and please go and get some professional help with that. So what is incremental borrowing rate on the next slide? It's the rate of interest that a lessee would have to pay to borrow over a similar term with similar security to fund the necessary obtaining of an asset in a similar economic environment. Now, the three red highlights there, similar term, similar security, and economic environment, those are three key drivers. We are not talking here about your revolving credit rate for other borrowings in the business. What we're actually talking about is the incremental borrowing rate for the lease that you've entered into over the asset, which is a right of use asset, which has similar security, which in this case is the right of use asset, and a similar term. And the term is the thing that seems to be of most importance in the starting point of this, because Aletta spent a lot of time talking about what's the lease term. Well, if you don't know what the lease term is on your asset, you can't really determine your incremental borrowing rate. So this is actually connected to your determination of your lease term, and it's also connected to things like, have you renegotiated the lease or entered a lease modification, because your incremental borrowing rate is set at specific times in the lease arrangement, and it's not reset until various specific things are met. Now, I've had clients, a vast majority of them, who keep saying to me, "Oh, I have to reset my incremental borrowing rate at the end of every reporting period," and that is the first myth that we need to dispel. The lease incremental borrowing rate is not reset at each reporting date, but it is reset when various conditions are met, which I'll come to in a moment. But let's go back then to what a lease incremental borrowing rate, how we build this up. The theory behind this is that you build this up specific to the lease. You build it up based on the economic factors, almost like a base rate, which is normally sort of some sort of risk-free rate that is in the economic environment that you're operating in. So you might be operating in New South Wales, and so you might start with a risk-free rate, using, I don't know, New South Wales government bond rate, but you also might use an Australian Commonwealth bond rate as a starting rate. And then you add financing factors and asset factors on top of that, because you need to address financing factors that are specific to the company, but also asset factors that are specific to the right of use asset that you're renting, in this case, a leased property or whatever the underlying asset is. The impact of higher interest rates on the next slide, Aletta, is that model, which was on the screen before, it served us well in the past, but it's starting to unravel to a certain degree, because it's a theoretical model that builds itself up from a base rate. And the base rate that was used in the past was often, like I said, a government bond rate. But the problem with the government bond rate in particular is that the government bond rate doesn't mimic or doesn't represent the sort of arrangements that leases look like. And the best example of that is a 5-year government bond rate is often a bullet point type arrangement where you pay a lease amount, a repayment at the end, whereas most lease arrangements are monthly or at least quarterly repayments. And so starting with a base rate for economic factors that is often built up off a government bond rate, especially in the for-profit entity, is no longer serving us well, because that base rate actually doesn't mimic the term and value of the instrument, especially with things like repayment terms, and in particular, the timing of the repayments. And the timing of the repayments on a government bond rate versus the timing of repayments on a monthly property lease actually has a material impact on the discount rate. And we're finding that if you start with the wrong base rate and you start with the wrong tenor of a loan, you actually end up with sometimes 1 or maybe 1.5% difference between what your incremental borrowing rate should be if you adjust that rate back to actually reflect the financing and asset factors of the organization. The long and the short of it is we're actually seeing a very dramatic shift in the methodology applied in calculating incremental borrowing rates, away from base rate plus financing factors to an actual proper credit risk assessment, where we actually start with the credit risk and the credit profile of the entity, and then we adjust for asset factors. You almost don't see a base rate anymore. What you actually see is you see an incremental borrowing rate built up on a credit rating, comparable company arrangement first, and then adjusted for factors that are lease specific, like the security and the term of the lease. Now, I've already said we don't reprice these things at every reporting rate, and I've already kind of mentioned that IBRs are no longer insignificant and immaterial. So what we'll jump through then is some of the base core assumptions that you need to factor in, like when do you change your incremental borrowing rate? First thing is you do not change your incremental borrowing rate every year. I've already said that. The way incremental borrowing rate is, it's actually a factor of the pricing of the arrangement. And really that means, if you really look at this sort of from a commercial point of view, you should only be repricing your incremental borrowing rate when you reprice the underlying contract. So what does that really mean in practice? One, you do need to determine your incremental borrowing rate at lease commencement, because that's when you price your contract. That's when you're entering into the agreement. But I need to make sure that entering into the agreement at inception and lease commencement, where you actually take or where the asset is made available to you, are two different dates in the accounting standard. And the way the accounting standard works with borrowing rates is we do lease commencement date. Now, I never realized how dramatic that was, because some organizations are actually entering into lease agreements almost as options for lease agreements, where the property is or the asset is only made available 6 or 8 months later. That can have a dramatic impact on what your IBR is at lease commencement if you actually pricing it at the time you sign the contract. So that's the first thing to take into account, is what is your lease commencement date that the asset's made available to you, and you price the contract or you price the IBR at that point based on the term that exists at that point, plus all the other credit factors and so forth that are applicable. You do not change the lease incremental borrowing rate for each lease until some of these other factors occur, like, first of all, a lease modification. Now, letters already referred to that. So when you've got a change in the scope of the lease or consideration of the lease, which often involves a renegotiation of the terms with the lessee, that is a lease modification. But until you do that, the lease just carries on at its former IBR. Now, I have seen something that has popped up maybe once or twice. That's floating rate resets. It's actually quite rare, but I just want to put it on your agenda that I did see one the other day, where the rental changes based on an underlying interest rate. And every time the underlying interest rate changes, the rental actually changes. That is what we call a floating rate reset, and it also might drive a change in incremental borrowing rate. It's limited, so I put limited in brackets, but if you do have rental adjustments that are linked to some sort of interest rate or LIBOR is the one they use in the textbooks and in the literature, but it could also be something like an interest rate or a bank rate or swap rate. You might actually have some sort of reset there. Just keep your eye out for those. But the one I want to focus on is the business combination accounting and also the reassessments. Something that has cropped up, and I want to put it on your agenda, is business combination accounting. Now, Aletta's going to deal with this later on, because we do see a lot of business combination happening when an acquirer acquires a business and they acquire the interest rates of the business. That may not change the incremental borrowing rate of the acquiree of the target, but the acquirer has acquired a new lease in terms of its business combination, and that would require a reset of the incremental borrowing rate. And there is a lot of literature around which IBR do you use. Do you use the IBR of the acquirer, or do you use the IBR of the acquiree? The lesson in this is that the incremental borrowing rate actually changes for the consolidated or for the acquirer's books, and it's separate to what the acquiree is using down below. So you suddenly end up with two sets of accounting books there. So that's another place where the incremental borrowing rate changes. And then the last one is when there's a reassessment. Now, what do I mean by reassessment? When there's a change in the lease term because of a change in your assessment of the likelihood of exercising or failing to exercise an option. This is interesting because you don't just reassess the lease term at each reporting date based on what you think you want to do. You actually need to reassess that only when there's a change of an event that is in control of the lessee. What does that mean? Something I've seen lately is that companies come to me and say, oh, I've got this 5-year lease, and then another 5 years after that with an option. And when I originally entered into the lease, I made the assessment that it was a 5-year plus a 5-year lease, in other words, 10 years, because I thought the option would be reasonably certain to be exercised. But I've now looked at the changes in the market rent. I'm not sure I'm going to actually exercise that option anymore. So I changed the lease term. That's not actually appropriate under the accounting standards. And the reason for that is because you actually have to have an event or a condition that is within your control before you can actually make an assessment of a change in lease term, which would then reset your incremental borrowing rate. And a good example of that is you've decided to divest from a region and move the premises somewhere else. So therefore, there's actually an event that you've controlled, a business plan event, and off you go. Why I'm putting this on the agenda is I actually saw an entity the other day who wanted to argue that they were changing all their lease terms because they didn't want to actually have a lease liability that was too big on their balance sheet. So they made up an argument that market rentals had changed, so they weren't really certain whether they were going to stay in the premises. And what actually happened is they would have reduced their lease liability quite substantially. And it turned out their incentive for doing that was because they were about to breach covenants on their lease liability. So they actually didn't have an event that was in their control, business plan related. They were really just trying to manipulate the lease liability and argue that their lease term had changed. Be careful of those scenarios. Lease terms and hence a reset of incremental borrowing rates only occur when there's a condition that's in with control of the leasee, and it affects whether you're going to actually reasonably be certain to exercise that that interest rate. So on the last slide then is, once we've kind of unpacked when our IBR is changing, the point if this one is that starting with a current borrowing rate and starting with a base rate, like a risk-free rate where you build up an interest rate, is something that I'm starting to see is no longer the way to do it. It is certainly allowed in the literature and it is certainly allowed in the standards, but what we're actually finding is more and more what I call a corporate finance approach is starting to emerge, where auditors and entities are realizing they actually need to look at the entity as a whole, do a credit rating assessment, and then build up a credit spread on top of that. Now, these are all acceptable approaches. I'm just communicating to you that more and more I'm starting to see auditors are not accepting the, shall I call it, the base rate build-up case. And the reason for that is that selecting the correct base rate or risk-free rate is fraught with danger, because the term and the tenor doesn't match your underlying lease. And so you end up just with multiple adjustments that are needed to make in that scenario. So rather what's happening is more and more entities are actually saying, go and get a proper valuation of your IBR, get a corporate finance entity or corporate finance function, somebody like a valuer, to help you actually do a credit rating assessment of your organization and then move from there. Now, Aletta, we're running out of time, so I think we'd probably need to pick up the pace a little bit, and I'll do these two sessions that I've got being a make good provision a bit quicker.
Sorry, Kevin, it was a slip of my finger. I was hovering above. I didn't mean to rush you at all, Kevin.
So let's have a look at make good provisions. This is somewhat esoteric outside of the lease accounting, but it's certainly linked. Make good provisions are clearly becoming material. And in 2019, when we started this, in some cases, make good provisions weren't even recognized alongside some of the leases. But Aletta will nod her head, because more and more we're seeing that make good provisions are being reassessed, and they are certainly becoming material. And what that means is, alongside your lease accounting, you've also got your make good accounting going on. Now, when we recognize make good provisions, it's a simple entry. Credit the make good provision under a separate accounting standard, IAS 37 or AASB 137, the accounting standard that deals with provision, and then debit the related asset. That is sort of the base theory. What we're finding, however, is that there's a misconception about where that debit goes to, but also there's a misconception on how you measure the credit side, being the actual provision itself. So this is not quite lease accounting, but it certainly interacts with lease accounting. So first thing I'm going to kind of point out to you here is that the debit side of the entry actually needs to be clearly understood. When you're entering into a lease and you make an initial estimate of the make good provision, you actually do need to understand what the make good is. So for example, if I enter into a lease and I've got a make good provision that's really just restoring the premises to its original condition, that is different to a make good provision that actually has to dismantle physical adjustments you've made to the premises that you might be leasing, because they actually go to different places in the accounting standard. And the best example of this is you enter into a commercial property and you put up paneling, or you might even break down some walls and you might put some paneling to create offices. And there's really two sorts of provisions emerging there. Dismantling the infrastructure you've put up, like walls and paneling, and restoring things like painting the walls and putting it back into the condition that it was previously. Those are two different types of provisions. And where do they go to when you actually recognize on the balance sheet? Yes, you have a credit entry being your estimate of the make good provision, but the debit doesn't always go to the right of use asset. The right of use asset would normally absorb things like restoring the leased premises to its original condition, but sometimes actually dismantling improvements that you've made to that asset won't actually go to the right of use asset. It'll go to PP&E as a make good a leasehold improvement PPE asset. And why that's different is because you actually get a very different answer on what your ROU is and your PPE is. On the credit side of the entry, and later I'll move to this side just relatively quickly, more and more we're seeing that the theory behind measuring make good provisions is actually something that is somewhat misunderstood, and there's also many different ways to do it. So there's lots of different ways to actually measure your make good provision. Let's on the next slide. Common method we see in practice to estimate the make good itself is to get obtain a reasonable at present estimate of expenditure. How much would it take to restore or dismantle this thing that I have to do in terms of my make good, which is a present value or an at present estimate. But then the accounting standards actually talk about estimating that number into the future and discounting it back to its current rate. So now your question is, do you use the at present estimate, or do you gross up the at present estimate into the future for inflation and then discount that back to some sort of present value calculation? And the answer is it depends what method you select. There are a number of methods you can use to do this, but whatever you do to estimate the at present or the present value amount of your make good, you have to make sure that the discount rate that you present valuing your provision at factors in or doesn't double count the effect of inflation, first of all. And second lesson, it's not the same as the incremental borrowing rate that you use to discount the provision, because the provision is a different calculation subject to different risk factors than the lease itself. Lots of variables going on here, but the key message to take out of it is that you almost need an accounting system to manage your provision measurement similar to your accounting system to measure your lease liabilities. They are not the same accounting measure. They might be driven by obligations in a lease agreement, but once you actually have the obligation for the lease liability and you have the obligation for the provision, at that point, the measurement is different because they're subject to different risk profiles. They're subject to different discount rates. The discount rates are not the same. And in fact, I'll go as far as to saying that you don't even calculate the discount rates for those two amounts in any way or form linked to each other. There's no common starting point for them. They're different variables. And making sure that the debit side of the entry for a make good provision interacts correctly with the right of use asset. Sometimes it does go to the right of use asset, but sometimes it goes to PP&E. I'll leave you there. Yes?
I just want to add that in BDO lead, we can actually deal with this make good provision side as well. So although we do the normal lease liability right of use asset, we also can deal with this separate IAS 37 provision at the different discount rate. So just a plug for our technology.
And we've done that for a number of, it's interesting the number of clients that we have who do lease accounting with us in Sydney, and I suppose it's in Melbourne as well, where we didn't previously do provision accounting, but now they've come to us to help us with that because their provisions have become material. And that kind of leads me to the last slide on this presentation, which is when you do start to actually change those make good provisions going forward, there's a whole set of rules about re-estimating the provision and where does the related debit or credit go. And sometimes it goes against the asset, sometimes it goes against the revaluation reserve, and sometimes it hits profit and loss. So you actually need to actually have a separate system set up to cater for how you monitor your provisions related to leases to get that right. That slide I've got on the board is really just your Bible on how you cope with these things once you actually have an adjustment to the provision. I'll leave that as self-study. Impairment I'm going to whip through very quickly for you, and I'm actually just going to refer you to some of our guides for further detail. once you have a right of use asset on your balance sheet, it sometimes is subject to impairment, because just like any other asset, you need to assess it for indicators of impairment. And the one I come across often, so these impairment indicators are actually just straight out of the standard. The difficult thing with right of use assets is that the accounting standard on impairment wasn't written for right of use assets. So it's sometimes difficult to apply the impairment standard for right of use assets because it wasn't written when right of use assets existed as a concept. So you actually have to take things like impairment indicators, which are on the screen now, and adapt them to actually apply to right of use assets. And one of the best examples of this is when you've got an internal source of impairment indicator. So for example, internal reporting indicates that the economic performance of the asset is worse than expected. And the one above it, where it says evidence of obsolescence or physical damage to the asset. Now, if, for example, your provision for obsolescence or your dismantling provision goes up because you've damaged the property more while you've used it, well, that's going to be an increase in the provision. The other side of that is probably going to be the right of use asset or the PP&E, depending on where you take the debit. But that is then also an indicator of impairment, because now you've added more money or more value to the right of use asset, and you've got to try and support that recoverable amount. But it also might be the other one we run into is you're not using as much of your lease asset as you used to, and especially in a time of work from home, entities are finding that they might have leased 5 floors 5 years ago, but now they only need 3. So the question really is, how do you deal with impairment for leases? The best example on the next slide, Aletta, is what I call the 5 office floors example. Now, there's a bit of an inconsistency here. I'm referring to the IFRS in practice that is 1 year ago. Aletta made reference previously to our IFRS in practice, which was the next year's version. The reason why I've actually referred you to a 1 year ago IFRS in practice is because there's a couple of examples in there are really, really basic to understand. And the later version of the BDO IFRS in practice actually adds more complexity onto it. So it's almost like if you want to get to know the concept, start with the version a year ago and then build up your understanding with the latest version of BDO's IFRS in practice. But this example is going to be a self-study example for you. The first question when you've got right of use assets, especially around property, is what's your unit of account when you do impairment? If you sign one lease, but it's got 5 floors, and those 5 floors operate independently of each other, do you account for them as one lease, being the lease agreement, or the 5 floors that you use independently of each other? And that's the first question you have to kind of deal with in accounting, because when you deal with accounting for leases, you actually deal with lease components. You don't deal with one lease agreement is signed. So you actually might have 5 leases or 5 lease components that you need to account for. And sometimes you account for those separately, separate unit of account. And that then flows into the impairment, because then you do impairment on a separate basis. Five office floors have separate leases of account. And I've pulled onto our next slide the guidance out of our guide that talks about, first of all, establishing whether you have separate lease components, and then how does that translate through the arrow into the impairment or the impairment assessment. Because you can easily have, if I take my 5 floors and I'm using 3, you can easily have 3 floors that don't have an impairment of an indicator of assessment, but the other 2 do, especially if you're not using the other 2 and you're trying to find a tenant to sublet them to. That could be an indicator of impairment on the 2 floors that are now surplus to requirements. So it's important that you understand, first of all, the right unit of account, whether you have separate lease components, and then whether those impairment indicators are applied against those separate lease components. And you can have a scenario, which is what's dealt with in our guide, where 3 floors are actually aggregated together with a CGU impairment test, but the other 2 floors are being rented out separately, and they have their individual and their own recoverable amounts, because actually they are separate cash generating units all by themselves. They're generating income. So very complex area. And the moment you hear indicator of impairment or indicator assessment on right of use asset, you should probably get to grips with unit of account. How do I apply the impairment indicator? And then how do I run the model to actually prove there isn't an impairment here? Because auditors are asking more and more for these assessments to be done. In the interest
Kevin,
of time, yes, Aletta.
I might just say that we've seen this quite a bit. When people initially adopted IFRS 16 in 2019, there wasn't desire to have less leases to manage and less leases to do calculations for, practically, right? And people would combine the 5 floors into one, um, and say, let's deal with them as one. And now, a number of years later, when with COVID, there's a reduction in the use of the asset and we're using different floors and we revisit that assessment, we realize, hang on, the unit of account on day one should have been 5 different floors and not one. Now,
Yeah.
practically, the actual numbers weren't wrong, whether you had it 5 together or 5 separate. It wasn't an issue then, but it becomes an issue later on around usage and potential impairment. So actually, it's really important on day one to look at this carefully. It doesn't impact your actual number on day one, but it does impact the future. And we had to do a lot of work to go back and fix this and separate them out. So that would be a lesson we've learned.
And I'll bring it together in this section before I hand back to you, Aletta. The increases in the provisions for make goods and dismantling often give rise to an increase in the related asset, whether that be a PP&E or right of use asset, and that flows straight into, do I have an impairment, because suddenly I've got more asset value to justify on my balance sheet. And I'm finding that interconnected play an enormous risk coming into the June 24 year ends. These slides I will not talk to and round this out, but it's just a reminder that if you are including your right of use asset in your CGU impairment value in use models, you need to adjust the cash outflows for lease payments to be consistent with what you've done in the CGU by including the right of use asset in the asset base. And often what you find is, and this is the first of all, which one is the right one? The answer is it depends, but really the right one is, on the last slide, is you should be including your right of use asset in the CGU and backing out the lease payments that relate to that right of use asset. However, you have to make adjustments not only to the terminal value and the discount rate, because often leases don't extend into perpetuity, they only extend for a short period into the future. So you've got this adjustment you have to build into a model to cater for the fact that once the lease ends, your cash flow model needs to reflect some sort of investment into a lease or a lease payment or even a capital maintenance for leases in order that your terminal value actually caters for that. So a lot of complexity going on in this space.
Thank you very much for that, Kevin. Amazing that we're seeing similar things in practice, and I think quite a number of new challenges that we'll see in 30 June as well. Subleases is just a reminder that if you are leasing a property and then you're subleasing the property, as the lessor in that sublease, you still have to distinguish between a finance lease and an operating lease, and that will then establish the appropriate accounting treatment, whether you de-recognize the right of use asset and replace it with a lease receivable for finance leases or not. So just a reminder around subleases, and that you are comparing the term of the sublease with the term of the head lease, not with the useful life of the asset, in order to assess if it's a finance lease or an operating lease. On sale and leaseback transactions, now this is one that I'm seeing a lot. You can imagine a lot of entities at the moment, there's a little bit of a cash squeeze. The economy is not running on all cylinders. So a lot of entities are thinking, let's sell some of our assets, but we still want to use the asset because we need it for our business. So we sell it and we lease it back. And then the question is, if you do that sale and lease back, what is the appropriate accounting treatment? This is an extract from IFRS in practice, discussing the considerations. So if you've got a sale, the first thing is it a real sale under IFRS 15, all right? And if it is, and you then lease it back, let's look at that lease and look at the consequences. Or the alternative, if it's not a real sale, what have you done here? You've just obtained financing with the asset as security. So what's the substance of what happened? Not that there's a sale legally and a lease back legally. It could be the substance is we've just obtained financing. So we've got a little bit of a summary of what this could mean for the lessor lessee. You know, there's two columns, one for lessee, one for lessor, but also, you know, if it qualifies as a sale, so it's genuinely a sale under IFRS 15, what are the consequences? And then also if it's not a sale, so it's more financing, what are the consequences? So it's a reminder of that. I'm seeing quite a bit of this at the moment. Then I know we've talked about it before, but I just want to reiterate that interaction with IFRS 3. Kevin, you were talking about running 2 sets of books. I actually have some clients running 3 sets of books because they run their old books, the entity, the acquiree. They have a set of books in IFRS 16. They've been acquired, so the acquirer is running the same number of leases under IFRS 16, new IBR, new everything, and voila, 3rd set of books using US GAAP, because the acquirer reports under IFRS 16 and US GAAP. I'm coming across this a lot. Now, finally, BDO Lead can do both. So our technology solution can do IFRS 16 and the US GAAP. And we're busy with a big transition project for a few clients where we're setting up all these sets of books. Now, the one thing that I want to say on IFRS 3 is it's really important to consider the adjustments we made. So at the date of this transaction, if we're still with IFRS 16 there, for the acquirer, this is a new lease. They set their IBR at that date, and they work out their lease liability. But the other thing is there's also a consequence for the right of use asset. And this is where we use corporate finance and valuers, because they will have to say, this lease that we've acquired, it could have been that we've acquired the lease and the lease has favorable terms, or the lease has got unfavorable terms. And whatever it is, it will therefore have an impact not on the lease liability. The lease liability is factual. This is what I'm committed to pay. But whether this contract that I've acquired is favorable or unfavorable will actually have an impact on the value of the right of use asset at the date of the transaction, because we're bringing in all assets, all liabilities at fair value. And the right of use asset, step 1 is we calculate the right of use asset. Remember I said earlier, you work out the liability, that becomes the right of use asset. And then you adjust that right of use asset for the consequences of favorable, unfavorable. And what I've extracted here, there's 2 different ways that you can come up with favorable, unfavorable. And it's very interesting working with the values at the moment. Are they looking at discounting the payments in future with this new IBR and comparing it with what we have in the books? Or alternatively, that I've got here in the 3rd last paragraph, you can be looking at that rent differential and how that plays into working out favorable, unfavorable. And I've seen both in practice. Gives you the same answer, just a different approach. And then finally, I thought I'll just throw out US GAAP. BDO Lead can do US GAAP. We're getting a lot of situations where they now have to run numbers under IFRS 16 to lodge in Australia with ASIC, but also prepare US GAAP numbers to lodge with a parent in the US. So please speak to us if you're looking for any of that. Now, Kevin, we've gone horribly over time. However, this is my favorite topic, so please tolerate us. Remember, if you look for an efficient lease solution, BDO Lead, developed by BDO Germany way back when in 2016, and Kevin and I have been selling in Australia since 2017, is an amazing tool, and there's some videos you can look at. But if you want to outsource and just get rid of the problem, we're happy to take the problem. We've got a team of people who look after this. It's all they do, lease accounting. Can you imagine? I think that's heaven. But we're happy to help you with that and take away the pain and outsource to us. Again, if you're looking for assistance from an IFRS corporate reporting perspective, these are our 4 partners nationally that you can speak to. You would know Kevin and I by now, but also our very experienced and trusted partner in Brisbane, Clark. and Lynn, partner in Adelaide. And we work together very closely, so please reach out to any of us. And this is our broad team across the country. Nice big team. We're very proud of this big team that we've built up over the last number of years. Kevin, way back when you and I joined BDO, this was a minute team. And now it's a nice and big team, really proud and high quality people in the team. And then you can register for our insights. Corporate reporting insights is going out tomorrow. I recorded the video yesterday. There's learning that you can access. And then if you're interested in sustainability, we've got different service lines and offerings. Kevin and I are passionate about carbon accounting, sustainability reporting, can also assist with strategy, and our audit partners can help with assurance. So this is a bit of an overview of what we do, and these are the people you can contact for the various things at BDO. Please feel free to reach out. I would like to say thank you for joining us today. I hope you have a lovely day. And next week, Kevin, it's your first sustainability webinar. I can't wait. Thank you very much. Have a lovely day, everybody.